Silver is down more than 30% from its 2026 highs. Right now, it's trading around $69–70 an ounce. And if you'd been watching the market 6 months ago, that number feels like a mistake. Here's the thing that doesn't add up. The supply deficit is still real. Industrial demand is still growing. COMEX inventories are still falling. Every structural reason people gave for the rally, it's all still there. Nothing broke. The story didn't change. But the price collapsed anyway. So what's actually happening? Is this the market telling you the bull case was always wrong? Or is it something else? A very specific set of forces pressing down on a metal whose underlying reality is moving in the opposite direction. That gap between what silver's fundamentals say and what the price is doing is the most interesting thing in the commodity market right now. And that's what we're going to work through. Before any of the specific numbers make sense, you need to understand what silver actually is. Because it's not one thing. And that's the whole story. Gold is essentially a monetary metal. People buy it when they're scared, when they don't trust currencies, when they want something that doesn't corrode over centuries. Its industrial use is real, but relatively small. Gold's price is mostly a measure of financial anxiety. Silver is something different. More than half its annual consumption goes straight into manufacturing. Solar panels, EV components, electronics, AI data center connectors, all of them run on silver. That makes it an industrial commodity, the same way copper is. And like copper, when the global economy looks shaky, industrial demand expectations fall, and the price follows. But silver also carries the precious metal bid. When geopolitical risk rises, some of that safe haven money that flows into gold bleeds into silver too. So at any given moment, you've got two forces that can pull in opposite directions simultaneously. A financial shock can hit the industrial demand outlook and crush the price, while the safe haven buying is trying to hold it up. A manufacturing boom can drive it higher, even while inflation fears keep gold elevated. The interaction between those two forces is what produces silver's volatility, which is consistently higher than gold's and often higher than most industrial metals. Think about whether you've ever actually separated those two forces when looking at silver's price movements. Most people haven't. They treat it as just one thing, a cheaper version of gold with a more speculative reputation. That's not accurate, and it leads to genuinely wrong conclusions about what's driving the price on any given week. Right now, both forces are active and pulling in different directions, which is exactly why the price is where it is. Let's be direct about what's pressing on silver right now, because the bearish case deserves a full hearing before anything else. The dollar index is sitting near 99.85 to 99.92, not at historic highs, but firm. A stronger dollar makes dollar-denominated commodities more expensive for buyers in other currencies. That's a real headwind, even if it's not a dramatic one at current levels. The 10-year Treasury yield is hovering around 4.42–4.43%. Real yields, stripping out inflation via tips, are running close to 2.1%. That number matters because it represents what you give up by holding something like silver instead of a bond that pays you interest. When real yields are high, non-yielding assets become harder to justify. It's not emotional, it's arithmetic. Inflation is stickier than expected. Core PCE, the measure the Federal Reserve actually uses, is running at about 2.8% year over year. PPI came in at 0.7% in February, hotter than expected. Jobless claims are around 210,000 per week. The labor market isn't breaking, which means the Fed isn't moving. At the March 18th meeting, they held the rate at 3.5 to 3.75%. Powell said inflation is somewhat elevated, and he pointed specifically to tariffs and Middle East oil prices as the drivers. The Fed's own internal forecasts now show inflation cooling more slowly than they'd hoped 6 months ago. No rate cuts are priced in for the next several meetings. That combination, firm dollar, high real yields, sticky inflation, a Fed with its hands tied, is a precise description of the environment that puts maximum pressure on metals that don't pay you anything to hold them. Add an active conflict in the Middle East driving energy prices higher, adding more inflation, slowing global industrial activity, and the short-term picture isn't ambiguous. This is not a minor temporary dip. This is a coherent macro regime pushing against silver. Anyone sitting in this trade needs to look that reality in the eye. Now step back from the macro noise, because there's a separate story running underneath all of it, one that moves on a much longer timeline and doesn't care much about what the Fed said last Tuesday. Silver has been in a structural supply deficit for 6 consecutive years. Global demand has exceeded global mine supply every single year since 2020. That's not a short squeeze. That's not a speculative event. That's physical reality accumulating year after year, and it shows up in a very specific place. COMEX registered silver inventories, which sit around 77 million ounces right now and have been trending lower. When warehouse stocks fall in a market that's already running a structural deficit, you get closer to a situation where the paper market, futures contracts, runs up against the fact that there isn't enough physical metal to deliver against open positions. That's what a physical squeeze looks like in a commodity. It's not the same as a short squeeze in a stock. It's mechanical. Delivery is real. The metal either exists or it doesn't. Something else is worth noting. Large speculative traders, the funds that move in and out of commodity futures, have cut their long positions in silver sharply over the past few sessions. On the surface, that sounds like more selling pressure. But washed-out speculative positioning is actually setup information. It means the weight of forced selling has already happened. The market is lighter. Less fuel for downside. More potential energy sitting there if sentiment shifts. Think about what a reversal in this kind of market actually looks like. It's not gradual. When physical tightness meets short covering in a commodity with falling inventory, the moves are fast and they're not telegraphed in advance. Here's something worth sitting with. China's silver imports hit an 8-year high in January and February of this year. Not a record in the context of a speculative frenzy, a record driven by real manufacturing offtake. Solar panel production is one of the largest and fastest growing consumers of silver on the planet. The photovoltaic industry has been pulling metal out of the market at a pace that mine supply cannot match. EV manufacturing uses silver in battery management systems and electrical components throughout the vehicle. AI data centers, and there are a lot of them being built right now, use it in high-performance connectors and cooling systems. These are not edge cases. These are the industries absorbing the largest capital expenditure commitments in the global economy at this moment. Some substitution has started happening in solar manufacturing because when silver got expensive enough, engineers started looking for ways to reduce the silver content per panel. That's real. But the overall growth in panel volume has so far outpaced the reduction in silver per unit. Net consumption keeps climbing. The more important point is this. Silver's industrial demand doesn't come from trading desks. It comes from procurement departments and engineering specifications. Those decisions are slower to reverse than financial positions. A fund can exit a silver futures position in minutes. A solar manufacturer can't redesign its production process in a quarter. That stickiness gives the industrial demand floor a different quality than pure financial sentiment. The market has been in deficit for 6 straight years because supply genuinely can't keep up. Mine development takes years. Existing operations aren't expanding fast enough. That math doesn't flip quickly. Options activity on COMEX has been running heavily toward puts over the past several sessions. The put-call premium ratio is elevated. Everyone is leaning in one direction. That sounds straightforwardly bearish. But extreme one-sided positioning in options markets tends to be a contrarian signal, not a confirming one. When the crowd is all on one side of the boat, the conditions for a sharp move the other way are building. Not because the crowd is always wrong, but because the market eventually runs out of sellers who haven't already sold. Pair that with the speculative long washout from Chapter 4, and the configuration starts to look specific. Not bullish in a comfortable way, coiled. The key technical levels are worth knowing. Support sits near $68. Resistance is at $72 to $73. The high-volume node around $70 is acting as a gravitational center. The price keeps returning to it because that's where the most trading has been done, and the market tends to orbit those areas until something breaks the balance. Below $68, the technical picture gets worse. Above $72, momentum turns constructive. Now think about the scenario. If the macro environment shifts even modestly, a softer inflation print, a dollar pullback, any signal that the Fed's posture is softening, the combination of physical tightness, washed-out longs, and elevated put positioning creates a setup for a fast, sharp move higher. Not guaranteed, but mechanical. The conditions for it are present. Silver miners, tracked by the SIL ETF, have been underperforming the metal itself since the rally peaked. That underperformance typically means compression. The miners haven't caught up. If silver stabilizes, miners tend to move 1.5 to 2 times as much as the metal on the way back up. That leverage is real, but it cuts both directions with equal force. The framework matters here because there are a lot of wrong ways to position for this thesis. The macro headwinds are real, and they may persist longer than anyone wants them to. The Fed isn't going to pivot on a single soft data print. The dollar isn't going to collapse because sentiment shifted. Anyone buying silver at $69 expecting a recovery in 3 weeks is making a trading decision, not an investment decision. And this analysis has not been about 3 weeks. Dollar cost averaging is not just a hedge against bad timing. In a commodity with this level of short-term volatility, it is structurally the appropriate approach. Enter in tranches. Let the price come to you on the way down if it goes lower, and let your earlier entries work on the way up if it doesn't. On form of exposure, physical silver, bars or coins, captures the thesis with no counterparty risk. The trade-off is liquidity and storage. SLV, the ETF, offers direct price exposure with full liquidity and no storage burden. For most retail investors, that's the cleaner instrument. Mining stocks via SIL carry amplified exposure, 1.5 to 2 times the daily move of silver, which is only appropriate if you genuinely understand and can absorb that kind of volatility without making bad decisions in the wrong direction. The $65 to $68 range represents a logical accumulation zone based on current support structure. An allocation of 5 to 10% of investable assets captures meaningful upside if the thesis plays out, without being a position that breaks you if the macro environment stays hostile for another year. The risks are real and should be named. A renewed dollar surge, a second inflation spike from an oil shock, a global demand contraction from a recession that kills industrial consumption faster than the supply deficit can support the price. Any of those could push silver lower before it recovers. This is not a one-way trade. No commodity thesis is. The gap between silver's price and its fundamentals is not a mystery. It's a macro regime, dollar, yields, Fed, inflation, pressing against a structural reality that moves on a completely different timeline. Those two things are not in equilibrium right now. At some point, they have to converge. The market is pricing silver for the world we're in today. The supply-demand math is building a different world. Where those two things meet is the trade. This video is for educational purposes only. Nothing here is financial advice, and nothing here should be treated as a recommendation to buy or sell any asset. Do your own research and make your own decisions. You're the only one who knows your financial situation.